Paul Bagnall. Welcome to Market Call here on BNN Bloomberg. Shane Obata is on the show today. He's Portfolio Manager at Middlefield Capital, and he'll be taking your questions on global large cap stocks. Let's bring in Shane Obata. He's with Middlefield Capital to talk a bit about the markets before we get to your questions to Shane. Shane, do you see signs that inflation, which is the big worry of investors, is beginning to ease or is about to ease?
I think we're starting to see signs there. That's obviously been probably the biggest headwind this year, aside from the Ukraine crisis, has been the interplay between high inflation and rates rising and how that plays into monetary policy, where we're seeing hikes pretty much across the globe right now to try to contain inflation. So the headline numbers and the core numbers obviously come out once a month. Those are going to take time to reflect some disinflation, but we are starting to see signs there. I think the first thing I would look to is really the commodity complex, which has come off quite a lot. I think I was just reading that wheat is now below where it was in March, I think in February. So we've seen a lot of compression in the commodity space. Gasoline is down for many days in a row now in the States, and we should continue to get reprieve at the pump there. And then I think spending is holding up pretty well right now, but we're starting to see consumers at least be a little more selective. And so, yes, we're hoping that peak inflation is behind us, but that may take some time to flow into the numbers that everyone watches on a month-to-month basis.
What do you make of U.S. earnings season so far and the guidance we've heard from corporate executives? There has been some concern expressed or some acknowledgement expressed about the strength of the U.S. dollar being a fairly significant headwind.
Yes. So the U.S. dollar has been on a very strong run for a while until recently. And hopefully we can see that come back down. But yeah, that's certainly affecting companies in the quarter. On the US front, it's hard to say. I'm not going to tell you this has been a good earnings season thus far. It's definitely been mixed and probably more negative than anything. But we're more concerned, or I should say we've been pleased with the reaction so far from the market, which is basically telling us that there is a lot of negativity still priced into equities. And so thus far, it's felt like a good enough earnings season so far. And then just getting into the specifics a little bit, one thing that we were paying very close attention to was the bank earnings, because we wanted to see any indications that the consumer was slowing down a little bit. And that's not what we're seeing. We saw another strong print from American Express today, and we're pretty optimistic on Visa and MasterCard as well. So consumers are still spending. So far, it's been a lot of looking out ahead and companies anticipating potentially further weakness, but we're not seeing that materialize yet in the current numbers for a lot of the things that we're watching.
Let's go to our email inbox for the first question of the day. The subject of Bob's email is Fiera Capital, ticker symbol FSZ on the TSX. Please give me your opinion, he writes, on Fiera Capital.
Yeah, Fiera Capital, Canadian asset manager that's done a good job growing and diversifying its business across its end clients, but more importantly, across different asset classes. So the biggest part of the business is still equities, then there's fixed income, and we're excited about the move that they're making into private markets. That said, we have seen pretty weak flow numbers from Fiera for the past little while, and that could very well continue into the near future. In terms of asset managers as a space, we have very little exposure there, and given that the bullish case for Fiera, in our view, is largely depending on the continued move into the alternative space, we would recommend sticking with more of a name brand company in that area. We really like Blackstone in the States as kind of the premier alternative assets manager. So not that we don't dislike Fiera, but we think that there are easier ways to play the growth of alternatives.
Okay, thanks for that question. Let's go to our phone lines for the first time in this program. John is from Milford, Ontario. Hi, John.
Good day, gentlemen. I would like your thoughts going forward on the Canadian banks. I own most of them, and I'd like to buy some more. I'd like to nibble away. What's your thoughts on this? Thank you very much. Bye.
Yeah, so the Canadian banks are not expensive whatsoever right now. I think that there are concerns about the broader economy, as we see with the U.S. banks as well, and financials are cyclical, and so they haven't performed very well this year. But I think there's also an element in the Canadian banks of speculators trying to suggest that our housing market is about to implode. So that would be faster money players in the States and other places trying to bet on that outcome through the Canadian banks. And so I think that's part of the reason that valuations are depressed. We are certainly in a very tricky period. Europe, I'm just going to talk about Europe quickly, but Europe is arguably already in recession. The States is kind of teetering there, and then Canada, we could expect similar outcomes there. So it's really a matter of your time frame. If we're talking about a longer term time horizon here, and that's how we invest here at Middlefield, then we're seeing good value in financials.
Okay, thanks, John, for your question on the Canadian banks. Andre is in Chilliwack, BC. Hi, Andre.
Hi, good morning. Thanks for taking my call. Shane, could I get your comments, please, on Qualcomm? It's having a rally. I'm just wondering as well, do you trust this little bear market bounce? And what's the result of these bear market bounces? Do they succeed, or do they just fizzle over time? That would be really helpful. Thank you. Have a good day.
Well, I wish I knew if this was the bottom, but I can't help you there. I don't have the crystal ball, unfortunately. But we've been happy with the bounce. I'll start with that first. I think that the market, like I said, had a lot of negativity into it. I think it's pretty consensus now that economic growth is expected to deteriorate. Profit margins are expected to come in. People are already positioned in defensive stocks, and their cash levels are high. And so the defensive positioning and negativity was already there. And I think that's a large reason that we're getting this relief rally. Now, we're going to have a lot of headwinds to kind of chop through over the rest of the year. But we do think the market the bar has been lowered significantly. So getting to Qualcomm specifically, this is a name that we've actually been adding to recently. We like the story. As we've seen from recent results like Corsair and STX and other companies, there's been weakness in consumer electronics, but I think this has been well known in the market for quite some time. So Qualcomm is kind of the other part of the market. Smartphones is another part of the tech market that people are kind of expecting weak results from. But the point is that we're often trying to determine what's priced in. And in the case of Qualcomm, that traded down to a 10 times forward PE. And at that point, it was pretty clear that the negativity and the worries were already priced in. So the stock has had a really nice rally before today off of the lows, but it's still not expensive. And we continue to think that it's a good name that should benefit over time as it diversifies and continues to grow.
Let's go back to our email inbox for another question to Shane Obata. Our email correspondent is Doug. He writes on Intel, ticker symbol INTC on the NASDAQ. Why does Intel keep slipping, he writes. Is it a buy at this point?
So the semiconductors industry has had a tough year, and that was coming off of a lot of strength. Basically, during the pandemic, you had a situation where demand for consumer electronics, among other things, was basically skyrocketing. And so we're continuing even to see excess demand in the semiconductor space. But there are worries about the cycle turning and with inventories rising. I already mentioned that people are a little more negative on consumer electronics and smartphones. And so that had been playing out until recently. There's been a pretty decent rebound in semiconductors. I think one of the key reasons that's happened is because of Taiwan Semiconductor's results, where they noted strength in the data center and other areas. So I think semiconductors is still a good place to be, but it's tricky for the next little while. I think it's still tricky.
How should investors understand the chip shortage in the context of these stocks?
So the chip shortage started off as really basically because there was such a large demand for consumer electronics because everyone was stuck at home. That led to chip shortages in other parts of the market, such as autos and whatnot. But we're seeing now some indications that the supply situation is improving. And so we think that situation will get better on the supply side. So now the question for semis really is, can demand continue to exceed supply? Will we see inventories rise to the point where we have to see prices come down and whatnot? So we're definitely bullish on semiconductors for the long run, but like many other areas, it's a difficult situation in the near term.
Okay, let's go back to the phone lines. Taraver is in Phoenix, Arizona. Hi, Taraver.
Well, hello, and my question today is on Palantir, which is the artificial intelligence consulting company. They have about 50% revenue from federal and 50% revenue from corporate. Revenue went up quite fast, profit not so much. My question is, are they really that good at artificial intelligence or just another run-of-the-mill consulting company? Thank you.
Yeah, so Palantir, we think it's an interesting story, but this is one that we're kind of watching and not yet involved in. To the question about artificial intelligence, it's commonly used now, people trying to show that they're doing that. And I'm not saying that Palantir is not good at it, but lots of companies across the world are trying to use artificial intelligence to improve their operations. So we would view Palantir as good at what they do, and that's really as data aggregation, taking data from different silos, putting it together and providing insights, specifically within the government, doing that while maintaining high security because there's a lot of sensitive information and whatnot. A couple things that we're a little bit worried about with Palantir is, first of all, there's a lack of visibility. When you're doing deals with the government for pretty sensitive areas, there's not a lot of visibility into the deal flow and negotiations and whatnot. And another thing for Palantir is that their deal size is actually quite a bit larger, significantly larger. I think it's around $8 million per deal size versus maybe something more normal in software would be 250,000 per seat kind of thing. So that just means to say that it's lumpier. And if we're in a scenario where companies start to retrench on spending a little bit, extending the duration that it takes them to sign new contracts and whatnot, that lumpiness could go against Palantir. So it's certainly on our radar. We think it's interesting, but there are a couple of things that we're watching and we want to see how they play out first.
Okay, let's go to Peter. Peter's in Vancouver. Hi, Peter.
Thank you. Sean, I want to ask you about Tesla. It's betting 3-1. Great results. But no, his Musk is a genius. But his move to try to acquire Twitter is not very smart. So can you tell me about Tesla? Is it worthwhile buying? Thank you very much, Sean.
Just going to remind callers, please turn down your television sets when you speak to us because we tend to hear the show coming back at us on a significant delay. Tesla, Shane.
Yeah, no problem. So let's start with the Twitter side. That's really a sideshow right now. And as a Tesla shareholder, it's not great to see that this is going to take up some of Musk's genius mind, as you said. So that I'm gonna leave that to the side there. But in regards to Tesla specifically, we continue to view them as the leader and the company to catch in the electric vehicle space. So the company is known for its technology first and foremost. They're a technological leader, but they're also vertically integrated specifically for electric vehicles, unlike their competitors who were founded on ice machines. And so the retooling and whatnot is much more difficult for competitors to do versus Tesla that's just made to build EVs. So there's a couple elements of the competitive advantage. Another one that we've been hearing is that Tesla is the best at sourcing materials for batteries and other things. So yes, the valuation is high and it's at a very high level. It looks unattractive relative to the market because it's so high. But even in the recent quarter, and despite concerns about, despite investor worries about the macro environment, Tesla kept their targets the same. And we think this is a company that continue to put out very, very impressive revenue and earnings growth, at least over the next few years. So we wouldn't bet against Tesla.
Time now for past picks. Shane Obata was with us on August the 9th, 2021, almost a year ago. Top pick number one on that day, Shane, was Amazon. Ticker symbol, of course, AMZN on the NASDAQ. Recommended at when the stock was trading at about $3,342 US per share. There has since been I believe it's a 20-for-1 stock split. So the stock now trading at $125.31. When you take that stock split into account, the return and total return figures, again, accounting for that stock split, are negative 25%. Shane?
Yeah, it's been difficult, but so has the entire market this year, and we continue to like Amazon for the long term here. The next quarter is probably going to show some lumpiness in e-commerce, in the sense that we know that transportation costs are still a concern. And we're still kind of normalizing it in that part of the business. When we had COVID, we had outsized demand for e-commerce, which made sense because people couldn't go outside. And then Amazon responded to that by building up capacity. Now they've been left with a little bit of excess capacity on the e-commerce side. But ultimately, we think these are all just moves that are happening around the trend line, which continues to go up as e-commerce penetration gets better and better. We think Amazon is a clear leader, and we continue to view them as the best in logistics. The other part of Amazon that I'll touch on is that that's really where a lot of the focus has been on the e-commerce side of the business. But we're most excited about what we're seeing in AWS and also in the advertising business. Those two segments are growing faster and they have higher margins than the e-commerce business. So as they continue to grow faster than the e-commerce business, that will lead to higher group profitability, and the company can continue to reinvest that higher profitability into making all parts of its business better. So we continue to like Amazon. It's been tough so far, but we think that people should be patient and give this company the benefit of the doubt.
Okay. Past pick number two on that day in August of last year, a company that you've referenced in passing today, Taiwan Semiconductor, TSM, on the New York Stock Exchange. Recommended when it was trading at about $118 US per share, now trading at $87 and change, a return of negative 26%, a total return of negative 25%.
Yes, another tough one here. Taiwan Semi is still a great company, and the world's premier foundry that counts many other great companies as its customers, Apple, AMD, Nvidia, the list goes on and on. We still think it's a great company. We still think that they're going to be a key beneficiary of the trends towards continued rollout or the continued ramping up of high performance computing in general. But the reason that we've moved aside from TSM is just because of the geopolitical risk. We are slightly worried about conflict between China and Taiwan, and so we just don't want the geopolitical headache from that standpoint. And then with the entire semis complex selling down, we're finding good value in other parts of the market. We just don't think we need the headache there, but it's definitely still a great company.
Okay, and past pick number three on that day, Uber Technologies, ticker symbol UBER on the New York Stock Exchange.
Yeah, Uber, we've sold out of our position. I think that there's two key secular themes at play here: ride sharing number one and food delivery number two. We still think Uber wins in those markets in the long term, but the near-term demand picture we're definitely worried about, and that's because this is non-essential spending, right? Ride sharing a lot of the time is non-essential, and then food delivery is definitely non-essential. And so as consumers retrench in the face of heightened inflation, we are worried about the growth prospects in that part of the in those segments. The other thing is cost inflation. Uber is on the road to profitability. It's one of those companies that's kind of teetering on the edge. It should happen soon, but as costs go up, whether that's employee costs, fuel costs, et cetera, that's going to eat into that profitability picture. And so again, this is a opportunity cost kind of idea. We think that the company will do well over time, but given the carnage that we've seen in the markets this year, there's just easier ways to make money, we think, than in Uber.
Uber down 40% or so since that day in August when Shane last visited with us. Glenn is our next caller. He's in Cambridge, Ontario. Hi, Glenn, and welcome to the program. What's your question to Shane?
Yeah, good afternoon, gentlemen. Thank you for taking my call. I was wondering if I could get an opinion from Shane on Sony. Thank you.
Sony is a great company, one that we've owned for quite some time. I think you're totally fine holding this for the long term. We do generally have a preference for, within consumer discretionary right now, for more reopening type exposures, getting back outside, that sort of thing. And so we're not as optimistic about gaming right now in general. Sony, though, is a diversified company. They have exposure to media through their pictures division. They also have a blossoming, well, I shouldn't say blossoming. There was some stuff with the Chinese companies and their image sensors business, but that's a business that we really like. That's actually what got us most interested in Sony, was the image sensors business, and we think that's got good long-term potential as well. So we like the name, but we're being very careful within consumer discretionary. So this is it's not a top pick right now, but we still like it.
Okay, thanks for that question. Our next caller is Vassal from Saint Laurent, Ontario. Hi, Vassal.
Hi. My question is about SAP, the software company. In my corporate days, you know, that was the go-to software, I guess, for enterprise and management and so on. And I've seen now that the price has come off significantly on all valuation metrics. It looks good. But my question is really, has it lost its place as a market leader? And what's your kind of position on the stock going forward? I'll listen. Thanks.
Right. Yeah, thanks for the question. So SAP is a name that we track, but we're not involved in. I would definitely, you're kind of alluding to the fact that it's definitely more viewed as a legacy software player. And I think over time, competing products from Microsoft, ServiceNow, et cetera, will probably eat into SAP's market share. So we think that it kind of muddles along, but we've got a long list of names that we'd prefer to own in software instead of SAP. So I know it looks cheap on the surface, but this is one that I'd kind of lump in with IBM and other names that we're just not, our expectations are not very high. And so we'd prefer to stick with some of our favorite software names right now. We continue to like Salesforce. We continue to like ServiceNow quite a lot. And then Adobe's dealing with some near-term challenges, but we think that's a good company to own for the long term as well.
Okay, let's go back to the email inbox. Ron is our email writer. TELUS and BC are the two stocks he wants to know about. What do you think about TELUS versus BCE? and the telecom sector as a whole?
Yeah, so the telecom sector, this market has been so difficult, as we've seen with the telecom providers in the States. And so once again, you have an area of the market that was perceived to give you a little bit of safety, which is now encountering its own headwinds. So it's tough out there, but ultimately we think TELUS is fine. We also in the States like T-Mobile, and we've been happy to not have AT&T and Verizon in this current week. So I think telecom is fine, but again, lots of the macro headwinds are really just permeating across everywhere right now. So it's difficult.
And what is the macro concern of the market here in terms of these companies, which are two of the big three in a very big industry in Canada?
I think the macro concerns are really just where can you pare back on spending, and then even worse potentially what we saw from AT&T. I'm not saying this is going to happen here, but people falling behind on payments, and so Verizon did not echo the same concerns, and I'm not saying that's going to happen here in Canada, but I think people are retrenching and choosing carefully where they're spending. So if growth is an issue going forward, then you could see similar reactions as we're seeing in the States. So again, you just have to pick your spots carefully.
Do the dividends support the stocks, or will the dividends support the stocks from further downside? BCE, and I'll remind viewers that BCE is the parent of this television channel through its Bell Media division, now yielding almost 6%. As those shares have come down, the dividend yield has gone up.
Right. Yeah, I think so. In general, telecom is we would still view it as defensive despite the market moves that we've seen this week. So I think that is a key attribute in the space that people will always come back to. So yes, I definitely think the dividends in this space provide some stability over time.
And TELUS yielding currently 4.7%. Its shares have also come down recently. Eddie is our next email writer. His subject is Alphabet. That's the company that I wish was still called Google, frankly. And the ticker symbol here, Google. So he's choosing the version of the stock that has an L after it. He also is writing about Microsoft. I'm thinking of buying Google and Microsoft for my son's TFSA account. Should I buy both of the stocks, or is there one that you particularly like the most?
We continue to like both. I will start off by saying that online advertising, or the advertising business in general, is cyclical. And so if we go into a period of economic contraction for an extended period, then even Google, which is our favorite name in online advertising, is not immune to that. So again, you have to think about what is your time frame. I think with a longer time frame, both of these are phenomenal companies. Google, again, I would view as the leader in online advertising for many different reasons. And then Microsoft, we like Microsoft. I think you may see some PC market weakness kind of seeping into the Windows portion of the business, but that's a smaller part of the business. We really like Azure, and we think that Office 365 take-up is going to continue on. So we're largely positive on both. We're very positive on both names over the long term, but once again, everything has to face some near-term challenges, it seems.
We have a couple of callers, one caller, one email writer on a similar subject. So first, let's go to an email from Max. Max writes as follows: I'm looking at MasterCard and Visa. Which is better to add to my portfolio? We also have on the line Glenn from Etobicoke. And Glenn, I think you're asking about one of these stocks as well. So Glenn was going to ask about Visa, Shane. So why don't you tackle on behalf for our viewers, Visa versus MasterCard?
Yeah, we would still put these companies in the fintech category, which has done extremely poorly in 2022 with names, former darlings such as Square and PayPal having a very tough time for different reasons. But the point is that we continue to find stability in this space with the card networks, and I would say we have a general preference for Visa. We would view it as a little bit safer. It's more US focused than MasterCard, which is more geographically diverse and upside to kind of global reopening. But in general, these are steady businesses. We found ourselves looking at a lot of duopoly, oligopoly type structures just across all of the markets because we think they have good positioning and in terms and good prospects for pricing power over the long term as well. So Visa and MasterCard, great way to play the continued normalization in global travel. It's really pent up demand for travel after people were locked inside. We think that trend continues to make a lot of sense, and we don't see any reasons for any near-term concerns there. So this is one area actually that we're pretty confident into the earnings print, not seeing too many indications of concern for these names. So these are definitely top picks for us.
Isn't it true that every time somebody uses a PayPal or a Square or another alternative channel, if you want to call them that they're at the end of the day, they're almost always using Visa or MasterCard?
It's a great point, and that was something that we thought about when fintech was all the rage, and we heard about all these new competitors coming up. But to your point, a lot of them use the Visa and MasterCard rails to authenticate transactions. So yes, that does happen in a lot of instances. I'll say that. I mean, Square is a company that we think is trying to build its own kind of closed loop ecosystem. When you're in an ecosystem, a payments ecosystem, if you're transferring money from myself to yourself, then sometimes you can avoid using the network rails, but that's still a long ways out. We think that Visa and MasterCard have like the greatest chicken and egg problem ever, in the sense that everyone uses them, and so merchants feel the need to use them, and then consumers feel the need to have them because all the merchants have them. So it's just it's a great business.
Okay, let's go to Anthony. He's our next email writer. Can I please have your guest's opinion on Brookfield Asset Management? Is it a buy?
Yes, we like Brookfield as one of the premier managers in the alternative space. I mentioned Blackstone earlier in the show, but Brookfield is another great player, well known for making good infrastructure investments. And I think you have to take a contrary viewpoint in this kind of environment. Who has the capacity to make deals? And I'm not saying that we're expecting a swath of deal-making activity in the near term. I think, generally speaking, as we've seen with the bank's kind of capital markets results, there's a lot of wait and see. There's not a lot of deal-making happening. But the point is that private equity players such as Brookfield and Blackstone, we think, can continue to raise money, and they're big enough that they can do the best deals in the market, and there's not a lot of competitors that can do that. Okay. The last thing I'd say quickly is just that it's our opinion that in times of tumult, people will look to, like they do in other parts of their business, kind of consolidate their vendors. So if you want to allocate to alternatives, and you had a long list of people that you were looking at, maybe now when the economic situation is a little more fragile, your short list goes down to a small number of players, including Blackstone and Brookfield.
Time now for top picks from Shane Obata. Number one is a pick that I think was mentioned during the course of this show, Nvidia, ticker symbol NVDA on the NASDAQ.
Yes, Nvidia. I think this is the first time I made it a top pick, which is pretty amazing because I really love this company. So again, coming back to the idea of near-term challenges, long-term value, I'll start off by saying that Nvidia's gaming segment may have some troubles in the coming quarter and maybe potentially for a little while here. This is partially due to the fact that GPUs were used pretty widely for crypto mining. And as we've seen that part of the market kind of pare back, there's been some changes to how Ethereum is mined too. And so now there's some supply issues leading to lower pricing, maybe some inventory issues for the near term here. But we think that the gaming business, we like it for the long term, but investors really need to stay focused on the data center part of the business. It was discovered a long time ago that GPUs are ideal relative to CPUs for artificial intelligence applications. And so Nvidia continues to grow at a rapid clip in its data center business, which is actually now its biggest segment, even bigger than gaming. So we think that potential weakness in the gaming market gets overshadowed by strength in the data center market. This is one of the purest ways to play the artificial intelligence theme, and we think this is a great long-term story.
Okay, top pick number 2, Motorola Solutions, ticker symbol MSI.
Yes, MSI, very interesting story that's really about 2 different segments. So the first one is the legacy segment, and that's really radio communications. And what do I mean by that? I mean handsets that we're using on construction sites, but also in mission critical applications, police, firefighters, et cetera. So there's a safety element to this story. That part of the business is something that we expect can kind of grow at around GDP growth. Nothing too special, but it's a steady long-term business. You'll see hardware upgrades every 6 to 8 years, and then there's software additions that come on. The company's been transitioning away from hardware and more towards software. We think that continues on, especially as it builds out its video solutions business. We think public safety is top of mind and should remain top of mind, especially in the States. As people look to protect themselves and fight crime even better, we think there's going to be more and more cameras on the streets. And when you have cameras, you need someone to manage the data so that you can use it for crime stopping and whatnot. Motorola Solutions does all of that. And we think that part of the business is really going to lift group growth and profitability going forward.
Okay, and let's finish with a pick in the luxury goods sector, LVMH, the Louis Vuitton company, MC on the Paris exchange.
Louis Vuitton is what we would view as the best luxury conglomerate in the world. The company operates across 5 different segments: fashion and leather goods, watches and jewelry, wines and champagnes and whatnot, and then we have selective retailing and cosmetics. So they have leading brands, the best portfolio of brands across those different areas. Fashion and leather goods is really the golden goose that consists of Louis Vuitton and Christian Dior, among other brands. That's the most profitable part of the group. We think that it continues to kind of power through, even despite the China restrictions. We think that the market knows about that, and we're expecting good, strong growth from the US and Europe to help offset some of that weakness that we saw in the previous period. So this is just a resilient name that we think you can own no matter what the economic environment. Luxury does not operate by the normal rules, and we think that LVMH has great proven operational expertise, great management team. It's a good long-term story for investors.
We have about 60 seconds left. Luxury does not operate by the normal rules. In other words, customers keep on buying despite global economic strains, a global economic slowdown, correct?
Yes, that, and also the fact that generally speaking in basic economics, we have rising prices leading to lower demand, but that's not the case in luxury. Luxury prices can continue to go up, and there's really an element of showing off, I guess you want to call it, or prestige, right? And so people continue to want these products even as prices continue to go up. We think Louis Vuitton has a lot of pricing power. LV is actually one of the only brands that doesn't discount ever. There's no there's no discounting outlets, anything like that. That to us is true pricing power in this space.
Okay, Shane, we want to thank you for stepping in today as our market call host. He's with Middlefield Capital, and he took your questions on global and large cap stocks. On behalf of our viewers, thanks to Shane Obata.